How to maximize portfolio return. In today's video, I'm going to be outlining to you my honest and frank opinion of having been in the industry for 15 years as how I would tell clients to do that. Guys, if you like the channel, please subscribe below. This lets YouTube know that we're doing a good job. Very few, I think only 10% of the people who watch the channel are subscribed. Please subscribe below. It really helps YouTube to know that we're doing good work. We've put a lot of time and effort in here. It's the biggest thank you that you can give us. Okay, how to maximize portfolio return. If you go and type this into Google or ChatGPT or whatever you want, you will get a whole range of things talking about tactical allocation and doing this and doing that and whatever. And I can honestly say that in my 15 years experience of being in the industry is absolute utter tosh. ChatGPT is basically just a selection of all of the top data and all the top articles online. The top articles don't necessarily mean they're the right thing. In terms of maximizing portfolio return, what I can say, and again, this is somewhat layman analysis because obviously I haven't done a spreadsheet and analysis and I haven't written a paper for it to go through a PhD, but basically what I can see from working with clients over the long term, the very best way to maximize your portfolio returns is to often shut up and do nothing. Now, that sounds strange, okay? Most people think, oh, don't you need to be tinkering all the time, doing this, doing that, checking this, checking that, selling this, better buy low, sell high, and all this garbage. No, it's an absolute fugazi, in my professional opinion. I've never seen somebody tactically allocating and selling and buying and selling and buying. I've never seen a client over the course of the years having made good money by doing this. And we see a lot of clients coming to us, and it's awkward, right? They come with their SIPP, they've been self-managing for 10 years. Often the inquiry might say something like, oh, I've been managing my SIPP for 10 years. I'm really familiar with financial markets. I don't need any advice on that, but I do want advice on like one specific thing or whatever it might be. You then go and look at their SIPP and I'm like, oh, okay. They're like, yes, it was like 800. It's now worth like $1 million. And I'm like, yeah, that's great. Like 200 grand, but that has been over the past 12 years. So you do realize even if you just thrown a dart at ETFs and trackers, you would have massively outperformed that. Now, some clients enjoy being challenged. 90% of clients don't enjoy being challenged. And at that point, they kind of like go back into their shell a little bit and say, yeah, screw those guys, I'll continue doing what I'm doing. But generally speaking, what I can say here at Cameron James, ironically, the clients who've had the very best levels of return, and I have clients who've been working with me for a very long period of time, are the ones that accept the advice, shut up and get on with it. Now, I know that sounds rude. I'm not telling my clients to shut up. But understand what you are a professional in and what you are not a professional in. There's no point taking your car to the garage and paying them £1,000 to have everything done if you're going to be in there at the same time saying, oh, hang on a minute, I'm going to use the spanner, I'm going to do this, I'm going to do that. They'd be like, what the hell are you doing? And in financial planning, it's the same thing. If you're paying a professional and you spent a lot of time and energy and research, understanding if you think they're a professional or not, let them do their services. And it's ironic that in my client bank, I have a range of clients, okay? And actually, some of my favorite annual review meetings are the ones where from a portfolio perspective, we always talk about portfolio. We always talk about performance. We always talk about risk. We check they have continued suitability. Has their attitude to risk changed? But that section of the meeting is actually small. We're focusing on all the other areas of their life that they actually can control. Inheritance tax planning, LPAs, wills, are there mortgages? What are they doing with everything else? Have they maximized their ISA, JISA, pension contributions? Doing all the things that are inside your control. But the foundational work that we've done with them at the beginning of their relationship with our investment philosophy is that equity markets will continue to grow. Past performance is no guide to future performance, but I am the firm believer over the course of the next 10, 20, 30, 40 years, the equity markets will continue to grow. If we actually look at the trend of the S&P 500, it's actually growing at an increasingly rate over the past decade or so in comparison to where it came from. So our opinion is that equity markets will continue to grow. So in terms of maximizing your portfolio, what you need to understand is the relationship between risk and reward. What level of risk are you prepared to take in return for the rewards on offer? If you take, for example, our balanced adventurous and adventurous portfolio, our adventurous portfolio has obviously outperformed our balanced portfolio, but it's taken on more risk to achieve that. So in a very simple scenario, say a client's portfolio has grown by 14% over the course of a period of time. We could then show them if they had a balanced portfolio. Say the balanced adventurous may have grown by 18%. The adventurous may have grown by 22% over that same period of time, whatever it may be. However, the client also has to understand in the opposite scenario, if there were to be a market crash and correction and markets drop by 25% over the course of a week, which can happen. Look at COVID, look at things like that. It can happen, these black swan events. Your portfolio would obviously have gone down more if you were in the balanced adventurous or the adventurous. Say the balance lost 25, a balanced adventurous could have lost 30%, and an adventurous portfolio could have lost 35%. However, over the course of time and the long-term equity trend of the markets, which is what we believe in here at Cameron James, that portfolio should rectify itself over the long term. So again, not to hark on too much about the point, but you should be doing that correctly at the beginning of your advice relationship with a financial advisor. Now, you may well sign up and you may be a balanced investor. You may stay balanced for the rest of your life and you're comfortable with that and you're happy with that. Here at Cameron James, what I typically see is a lot of clients, the majority of clients come out as balanced. I think it's the way that risk profiles are done and the questions that are asked. People sort of always end up closer towards the middle or balance. We do have a lot of interest investors, but balance, I'd say, is the most typical. For me, a lot of my clients, after they've been working with me, say a year or two or 3 years or even 5 years, they kind of looked at it and said, right, I did my research at the beginning. I was a bit unsure. I transferred $500,000, $1 million, $2 million, whatever it was. Now I can actually see that it worked. I see that I built trust with Cameron James. They're a good outfit. They're always in touch. My portfolio has grown over the period of time that I've been with them. Yes, it's gone up. Yes, it's gone down. Yes, we had volatility during certain market downturns, but I can see it's going in the right direction and they have trust and faith in the investment process. Typically speaking, they then ask about increasing their risk profile, or we may ask them, are you familiar with what the returns are of other portfolios? These come at an increased risk or a decreased risk. Would you feel more? And then clients often have a conversation and say, okay, actually, could you put a recommendation together for me on becoming a balanced adventurous investor for me to understand what the extra level of risk I'd be taking and potentially what the possible returns would be over the long term? Because for the majority of our clients, I mean, we don't work with anyone who says, hi, Dominic, hi, Jonathan, hi, Andiri, I'd like to invest £1 million and I want to withdraw it next month. Doesn't happen. This is long-term investment. Most people inside their pension pot may not be able to access it yet, but also the fact that it's going to be invested for a long period of time until their retirement and potentially even passed on to their beneficiaries. So it could be multiple decades before this money is actually realized, which gives them a very long-term approach to the equity markets. I hope that answers your question, and I hope I got rid of some of the fugazi that I believe is out there in the industry at the moment, and keeping it frank and keeping it simple. And as always, take care of UK pension assets.